Diesel supplies are reaching critical levels in the United States, in particular.
Diesel prices could go haywire the next 100 days.
Growing concerns over the diesel and heating oil shortage in the U.S. as we head into the winter months is really weighing on markets, certainly on investors' minds, with U.S. stockpiles at new lows and the price of fuel at record highs.
The cost to heat homes, power trucks, run machinery, everything diesel does is becoming a bigger problem for many Americans and companies.
Potential energy crisis looming over the markets. Diesel prices soaring as the inventory of distillate products is at a record low.
The country had only 25 days of reserves remaining.
The minutes from the last FOMC meeting are in, and I really think that the stock market is taking them the wrong way. While it's true that inflation for October came in lower than expected, it's not for the reasons that Jerome Powell is hoping for, and things could go downhill pretty quick from here. So let me show you exactly why inflation might peak again soon and force the Federal Reserve to take interest rates even higher over the next year. Your time is valuable, so let's get right into it. Let's start with the Consumer Price Index, or the CPI. The CPI measures the average prices that consumers pay for a wide variety of goods and services like shelter, food, energy, clothing, and so on. So if the CPI is an average of all these costs, then you can look at the change in the CPI to see if everyday goods and services have gotten cheaper or more expensive. This is one way to measure price inflation, which is what Jerome Powell and the Federal Reserve are trying to fight by raising interest rates. That's why the S&P 500 rallied by over 5% in a single day when inflation data for October came in lower than expected. And the NASDAQ went even crazier, going up over 7% because lower inflation data means the Fed has fewer reasons to keep raising rates. I know, this has been what everybody's been talking about all year. But here's my point. The CPI is an average, which means that some of the goods and services inside this index can go up in price while others go down. It's not enough to just look at the headline number and think that everything is fine just because the headline number went down. Another important thing to know is that some of the goods and services inside this index have much higher weights than others, and that makes sense since rent and food make up huge chunks of our overall monthly expenses. They should have a much bigger impact on this overall CPI number. If you want to have an edge over other investors in the stock market, one way to get it is by understanding the numbers that make up this average. Let's take a quick look at the weights of everything inside the CPI. Shelter alone accounts for over 32% of the index right now. Food accounts for another 14%. Transportation is about 8% of the index, while energy comes in at 7.5%. That means that just these four big categories, shelter, food, transportation, and energy, account for 62% of the Consumer Price Index. So clearly, these are the numbers worth paying attention to the most. Let's dig into the latest CPI data, and I'll show you what I think the stock market is getting wrong. Here's a chart from the New York Times showing the month-over-month price changes for the goods and services that we all rely on. Let's start with rent, since it accounts for over 30% of the CPI by itself. Rent of primary residences still went up 0.7% month over month. That's lower than the 0.8% that we saw in September, which is a good thing. But 0.7% per month still works out to be an 8.7% compound annual growth rate, which is still incredibly high. But wait, there's more. For most people, rent doesn't actually go up every month. Tenants typically sign one-year leases, and landlords usually raise their prices when leases get renewed. That means that the current conditions of today's housing market won't show up in the CPI until about 12 months from now. Even if it's going down, the Federal Reserve won't really see that yet in the numbers. Also, rental prices tend to be more sticky than, say, gas prices. Here's a quick test. Comment below if you've ever had a landlord actually lower your rent, or if you know somebody who's had their rent go down without moving. What actually tends to happen is that landlords will offer to keep rents the same, and only lower rents between tenants to keep their rental units filled. Even if the housing market is actually cooling, there's yet another problem. As the Fed keeps raising interest rates, mortgage rates will climb higher and higher. Newer landlords or landlords with variable rate mortgages are going to try to offset those higher costs by raising their rents, which means more upward pressure on headline inflation in the future. So shelter is actually a pretty noisy number inside the CPI, which makes housing inflation really hard for the Federal Reserve to predict and act on. Let's talk about food next, since it accounts for another 14% of the CPI and can be just as confusing. Food away from home climbed 0.9% month over month, which is an 11.4% compound annual growth rate. Meanwhile, food at home still went up by around 10% for the year on average. Both of these are much higher than the 7.7% year-over-year headline inflation number would suggest. Even worse, food inflation actually shows up in some pretty sneaky ways. One example is shrinkflation, which is where prices stay the same, but the amount of food you get is getting smaller. I think we've all felt that one at restaurants and at grocery stores. But another trick that food companies are pulling on us is by keeping prices and portions the same, but changing the recipes to include cheaper ingredients. That's called skimpflation, and it's not clear to me how these substitutions would show up in the CPI numbers, since both the product's price and portions technically stay the same. When I first heard about shrinkflation, and especially skimpflation, it really blew my mind. That's why this episode is sponsored by Noom, a mobile health platform that actually helped me have a healthy relationship with food. I see you there with your Halloween candy. Before Noom, I was definitely a 2 steps forward, 3 steps back kind of guy. But I've been using Noom for about 10 weeks now, and I've lost well over 10 pounds so far. What's the trick? Just one thing: a combination of human coaches, trackers for food, water, and exercise, a large library of healthy recipes, the best research from behavioral scientists, and quizzes that helped me understand why I was eating even if I wasn't hungry. Okay, that's like 7 things, but Noom's simple system makes them all work together. My favorite tip so far is replacing calorie-dense foods with simpler, less processed ones. I'm not kidding when I say that just a couple food substitutions have helped me save around 600 calories per day, like palmini instead of pasta, and frozen bananas instead of ice cream. Hey, don't knock it until you try it. And if you do want to try it, you can go to noom.com/ticker25 and use my code ticker25 to get 6 months for the price of 3. Thanks to Noom for sponsoring today's video. So far we've covered rent, which usually goes up at the end of a lease, rarely goes down, and can lag the rest of the CPI by up to a year. We've also talked about food prices going up, but also how shrinkflation and skimpflation might not totally be accounted for inside the CPI. Rent and food make up over 45% of the CPI when you put them together. The third thing I want to cover is energy, which is another 7.5% of the CPI. Even if you work from home, you do still feel it when the price of gas and diesel go up. It's not just filling your own gas tank that gets more expensive. The prices of freight and delivery are baked into everything we buy in-store and online, including food and building homes. The first thing you need to know about energy prices is that they're extremely volatile. In September, fuel oil prices were down 2.7%, and gasoline prices were down 4.9% month over month. But in October, gas went up 4%, and fuel oil went up a whopping 19.8% month over month. I honestly thought that this fuel oil number was a mistake, so I checked the raw data from the Bureau of Labor Statistics. It's not a typo. The latest inflation numbers show that fuel oil prices are really up almost 20% on the month and 68.5% year over year. At first, I didn't understand how the market could take this as good news, but after a few days of digging, I think I finally figured it out. Let's look at year-over-year numbers instead of month-over-month. In September, overall energy prices were up 19.8%, and gas prices specifically were up 18.2% year-over-year. And in October, energy prices were up 17.6%, and gas prices were up 17.5%, again, year over year. So what this looks like on the surface is a pretty big slowdown in energy price inflation, especially when you annualize some of these numbers. But just like with everything else I've shown you so far, there are a few problems with this point of view. The first problem we already covered, which is that energy prices are incredibly volatile. That means that these year-over-year comparisons are really noisy, and a 1 or 2% swing should be taken with a grain of salt. But there's something else adding even more noise to this data. The US government has been subsidizing our oil supplies by releasing a large portion of our Strategic Petroleum Reserve. What is that? The USA's Strategic Petroleum Reserve is a huge set of underground oil tanks that can hold over 700 million barrels of oil in total. It's maintained by the US Department of Energy, and it's the largest known emergency oil supply in the world. At the start of 2022, we had a little under 600 million barrels of oil in this strategic reserve. But at the start of November, that number was down to just under 400 million. The US consumes about 20 million barrels of oil per day, so the strategic reserve has about 19 days of oil left in it, which has been making a lot of headlines lately.
The country had only 25 days of reserves remaining.
That's not really as scary as it sounds though, because we don't only get oil from this reserve. The US imports plenty of petroleum from other countries, and we actually use these reserves for all kinds of different reasons, from offsetting the impacts of hurricanes and oil supply chain disruptions, to just straight up selling some oil to reduce the US deficit. But what is actually scary is that we're nearing the end of using these reserves to subsidize gas prices. Out of the 200 million barrels that we drew from the reserves this year, 165 million were deployed by President Biden specifically to help lower gas prices. And just this last month, President Biden announced that the final 15 million barrels of his oil budget will be released from the reserve by the end of 2022. And when these deployments stop, Goldman Sachs predicts that gas prices could jump back up to around $4.40 per gallon in 2023, as supplies get tighter and demand keeps going up as things continue to return to normal. But there's one more problem when it comes to the future of fuel prices, and that's the European oil embargo. Long story short, the EU is sanctioning Russia over their war in Ukraine. These sanctions ban sea-based imports of crude oil from Russia starting December 5th, and they ban petroleum product imports from Russia effective February 5th of next year. They also ban other countries from reselling Russian crude oil and petroleum products. Russia exports around 3 million barrels of crude oil and natural gas liquids per day, and about 1.3 million barrels of diesel and other petroleum products. If Europe won't get their oil from Russia, they'll have to get it from the United States and the Middle East. See the problem here? There's going to be even more demand on US oil and gas supplies in the coming months, domestically and abroad, thanks to these sanctions. And that demand will only get bigger if either the US or Europe experience a colder winter. The U.S. Department of Energy expects heating costs to spike this year. Natural gas bills could jump by 28% this winter, and heating oil costs could rise by 27%. Even electricity could rise by about 10% year over year. These energy price spikes are forcing lower-income families to make some difficult choices between heating their homes as temperatures drop or keeping food on the table. I try to keep my personal opinions out of my research and these videos, but my heart goes out to everyone who has to make these kinds of difficult decisions this winter. And again, these price spikes are coming from higher energy demand during a cold winter. The lower energy supply, thanks to the European oil embargo, is still ahead of us, which means that the final spike in gas and oil prices could still be ahead of us as well. And now we've come full circle. Rents account for 32% of the CPI. They don't go down very often and can lag the rest of the index by up to a year. Food accounts for 14% of the CPI, and there's hidden inflation in these numbers, thanks to shrinking portion sizes and cheaper ingredient substitutions. Energy accounts for 7.5% of the CPI, and we've been subsidizing energy costs almost all year, using deployments from the Strategic Petroleum Reserve. These deployments are about to stop, right as winter drives up energy demand, and the EU sanctions on Russian oil and gas lower the world's effective energy supply. Let me be super clear here. I do not think that the market is correctly pricing in the real possibility of another peak in inflation. When all of these things make it into the data that the Fed looks at over the next few months, Jerome Powell might surprise the stock market by raising interest rates higher than expected, or keep interest rates higher longer than expected, or both. That doesn't necessarily mean another 75 basis point raise on interest rates in the immediate future. It could be a couple of 25 basis point raises that turn into 50s, or a couple 50 basis point raises that turn into 75s. Or it could be that interest rates stay closer to 4% instead of 3.25% through 2025. If that happens, we could see another big crash in the stock market. Don't say I didn't warn you. But inflation isn't the only reason that the stock market might crash again over the next few months. If you want to know how bad the market could crash because of earnings, check out this episode next. And if you feel I've earned it, consider hitting the like button and subscribing to the channel, which lets me know to share more research like this. Either way, thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.